Every investor dreams of success, yet very few actually achieve it. The reason is simple. Most people focus only on making quick money while ignoring the deeper truths of investing. Howard Marks has spent decades in the markets. He has seen booms and busts, bubbles and crashes, greed and fear. Through it all, he learned that there is no single formula, no magic trick, no easy shortcut. Instead, there are many principles, many important things that together form the foundation of wise investing. This book is not a textbook filled with equations. It is not a collection of get-rich-quick tricks. It is a guide to how thoughtful investors think. It shows us how to develop judgment, discipline, and patience. Marks shares lessons from his own successes and failures, so that we may avoid common traps and survive the uncertainty of markets. The title might feel confusing at first. The most important thing. If there is only one most important thing, what about the others? Marks explains that there are many. Sometimes the most important thing is risk. Sometimes it is cycles. Sometimes it is price versus value. The point is that investing is complex. It demands attention to many factors at once. And here lies the secret. The difference between ordinary investors and extraordinary ones is not access to secret information. It is the way they think. Most people look only at the surface, but the best investors dig deeper. They think beyond the obvious. This leads us straight into the first lesson, the importance of what Marks calls second-level thinking. Without it, none of the other lessons in this book can be applied. With it, you begin to see the world of investing in an entirely new way. Chapter 1. Second-level thinking. In investing, most people think only at the surface. They ask simple questions. Is this company good? Will its earnings rise? Should I buy now? This is what Howard Marks calls first-level thinking. First-level thinking is fast, shallow, and obvious. It focuses only on what is directly visible. If the company is making profits, the first-level thinker assumes the stock will go up. If the market is falling, the first-level thinker panics and sells. But successful investing requires something deeper. This is second-level thinking. It is more complex. It asks questions like, everyone knows this company is good, but is it already priced too high? What if the growth slows? What if the crowd is overestimating? What are others missing that I can see? Second-level thinking is not about being smarter in every area of life. It is about being more thoughtful in specific moments of investment decision-making. It is the ability to see beyond the surface, to question assumptions, and to look at how others are thinking. For example, imagine a popular technology stock. The news is full of praise. Analysts give high ratings. Investors are rushing to buy. The first-level thinker says, if everyone is buying, it must be good. Let me also buy. But the second-level thinker asks, if everyone already expects great results, maybe the stock is overpriced. Maybe the risk is higher than it looks. Is there really more upside? Or has the market already priced in all the good news? Marks explains that second-level thinking is rare because it is uncomfortable. It requires questioning the majority. It requires patience and the courage to be different. Most people want to feel safe by following the crowd. But in markets, following the crowd usually means buying at the top and selling at the bottom. Second-level thinking also accepts uncertainty. It does not seek absolute answers. Instead, it compares probabilities. It asks, what is likely to happen? How is the crowd positioned? What are the odds of being right versus being wrong? What is the risk and what is the reward? Another example. During a market crash, prices fall sharply. First-level thinkers see fear everywhere and sell in panic. Second-level thinkers look deeper. They ask, are these assets now undervalued? Is the fear exaggerated? Could this be a rare chance to buy bargains? Marks reminds us that second-level thinking is the foundation of superior investing. Without it, you cannot identify value, control risk, or recognize cycles. With it, you can step ahead of the average investor and make decisions that truly add value. But second-level thinking alone is not enough. You must also understand how markets work. how efficient they are, and where their weaknesses lie. If markets were always perfect, then even second-level thinking would not help. No one could consistently beat the market. That is why in the next chapter, Marx takes us into the debate of market efficiency. He explains what it means, where it holds true, and where it breaks down. Only by knowing this can we see when second-level thinking creates opportunities. Chapter 2. Understanding market efficiency and its limitations. Markets are often described as efficient. This means that prices reflect all available information. If this were always true, no investor could consistently outperform the market. Every stock price would perfectly match its value. Every trend would already be known. Howard Marks explains that while markets are often efficient, they are never perfectly so. Human emotions, herd behavior, and mistakes create opportunities. Fear and greed can push prices far away from true value. Understanding where markets are efficient and where they fail is essential for successful investing. Efficiency is not just about the numbers. It is about human psychology. Investors overreact to news. They chase performance. They become euphoric in booms and pessimistic in busts. These behaviors make markets unpredictable in the short term, but occasionally predictable in the long term. Marx introduces the idea of market limits. Markets are usually correct, but sometimes they exaggerate. Sometimes they undervalue assets. These are the moments when thoughtful investors can gain an edge. Recognizing these limits separates great investors from average ones. An example: suppose a company announces strong earnings. The first-level thinker assumes the stock must go up immediately. The price often rises, sometimes excessively. The second-level thinker asks, has this news already been priced in? Is the market overreacting? What will happen if the next quarter disappoints? This thought process creates opportunities that others miss. Marx also emphasizes that market efficiency can change over time. In periods of calm, efficiency is higher. Prices generally reflect reality. In periods of stress or panic, efficiency breaks down. Mispricings appear, and risk-reward relationships change. Investors must be alert to these changing conditions. Understanding market efficiency also requires humility. No one can perfectly predict the future. Even experts often fail to foresee crashes or bubbles. The goal is not to be right all the time, but to understand probabilities and position oneself accordingly. The thoughtful investor combines second-level thinking with a sense of market efficiency. Knowing what the market usually gets right helps avoid mistakes. Recognizing where it is wrong creates opportunities. Investing is about navigating between these truths, acting with insight, and maintaining discipline. Marx warns against blindly trusting models, analysts, or news. Efficiency is a useful guide, not a rule. Markets are both rational and emotional. Great investors are aware of this dual nature and use it to their advantage. Finally, understanding efficiency connects directly to the next lesson. Once you see where the market can be wrong, you can begin to focus on value. You learn to separate price from worth and to invest where the potential gain outweighs the risk. This understanding of value becomes the core of smart investing. Chapter 3. Value. Understanding value is at the heart of investing. Howard Marks emphasizes that value is not the same as price. Price is what you pay in the market today. Value is what an asset is truly worth based on its fundamentals. This distinction is crucial for successful investing. Value comes from the underlying characteristics of a company or asset. These include earnings, cash flow, assets, growth potential, competitive advantages, and management quality. A thoughtful investor looks beyond the surface to estimate these fundamentals. Price alone is never enough. Marx explains that the market does not always price assets correctly. Sometimes it underestimates the strength of a company. Sometimes it overestimates it. The margin between price and value creates opportunity. If price is lower than value, there is potential for gain. If price is higher than value, there is hidden risk. For example, consider a company with strong cash flows, loyal customers, and a proven track record. Its stock may be temporarily undervalued because of short-term fears in the market. A first-level thinker might avoid it, seeing only temporary weakness. A thoughtful investor sees the value and recognizes a bargain. Value is not a fixed number. It is an estimate that requires judgment. No model or formula can perfectly calculate it. Marx stresses that value is subjective but can be assessed logically. Comparing value to price allows investors to make informed decisions rather than relying on luck or speculation. Marx also highlights the importance of patience. Markets may not recognize value immediately. A stock can remain undervalued for months or even years. Investors must be willing to wait. Acting prematurely or chasing short-term trends can erode potential gains. Value investing requires discipline. It demands that you ignore the crowd, resist hype, and stick to your analysis. The goal is not to follow the market, but to understand the intrinsic worth of what you own or plan to buy. This approach reduces risk and increases the chance of superior returns over time. Another key point Marx makes is that value is relative. Different investors may have different estimates of value. Your estimate may be more accurate if it is based on careful research and second-level thinking. The difference between your estimate of value and the market price is where opportunity lies. Finally, understanding value sets the stage for the next essential lesson. Once you can distinguish value from price, you must also understand their relationship. Price may fluctuate, but value remains the benchmark. Knowing how price relates to value allows investors to control risk, find bargains, and seize opportunities intelligently. Chapter 4: The relationship between price and value. Understanding value is essential, but it is only half the picture. Howard Marks emphasizes that investment success comes from the relationship between price and value. Price is what you pay. Value is what you get. The gap between them determines your potential reward and risk. If you buy an asset below its intrinsic value, you create a margin of safety. This means even if things do not go perfectly, the risk of permanent loss is lower. Over time, as the market recognizes the asset's true worth, the price tends to move closer to value, rewarding the patient investor. Marx explains that paying more than value is dangerous. When price exceeds value, you are taking on hidden risk. Optimism may push prices higher temporarily, but the probability of loss increases. Many investors fail because they chase price movements instead of focusing on value. An example: imagine a company with stable earnings and strong fundamentals. Its intrinsic value might be $100 per share. If the stock trades at $80, there is room for gain. If it trades at $120, risk exceeds reward. The thoughtful investor carefully evaluates both scenarios before making a decision. Marx emphasizes that price and value are dynamic. Market sentiment changes constantly. Fear and greed cause prices to swing above and below value. Investors who understand this relationship are better prepared to buy when others are fearful and sell when others are greedy. It is also important to recognize that value is subjective. Different investors may estimate value differently. One investor may see an opportunity, while another may see overvaluation. Successful investing requires independent thinking, judgment, and confidence in your own analysis. Another key lesson is that price alone is not enough. Chasing low prices without understanding value is dangerous. A cheap stock can become cheaper if the underlying fundamentals deteriorate. Conversely, a high-priced stock may still offer value if its long-term prospects are strong. Marx reminds us that the relationship between price and value is the foundation for controlling risk. Buying below value reduces the chance of loss. Buying above value increases exposure. This principle is central to disciplined investing and to all the strategies discussed in later chapters. Finally, understanding this relationship naturally leads to the next topic: risk. Once you know value and compare it to price, you can better understand the risks involved in any investment. Recognizing risk, measuring it, and managing it are the next steps for thoughtful investors. Chapter 5: Understanding Risk. Howard Marks emphasizes that understanding risk is central to investing. Many people confuse risk with volatility. They think risk is how much a stock goes up or down. But true risk is the possibility of permanent loss of capital. It is not about temporary fluctuations. It is about losing money in a way that cannot be recovered. Risk exists in every investment. No asset is without risk. Even cash or government bonds carry risk of inflation or default. The key is not to avoid risk entirely, but to understand and manage it intelligently. Marx explains that successful investors do not seek high returns blindly. They seek high returns relative to risk. Buying an asset that offers a large return but comes with excessive risk is often a poor decision. Wise investors aim to balance reward and risk, always prioritizing survival and preservation of capital. An example: imagine two investments. One offers moderate returns with low chance of loss. The other promises very high returns, but with a high probability of permanent loss. The first may be the wiser choice, even if the second seems more exciting. True investing is about staying in the game over the long term. Understanding risk also requires analyzing scenarios. What could go wrong? How likely is it? How severe would the consequences be? Marx encourages investors to think about worst-case outcomes. Planning for the worst protects against overconfidence and helps make rational decisions during market turmoil. Another aspect of risk is uncertainty. Markets are unpredictable. Events like recessions, wars, or policy changes can affect investments. No analysis is perfect. The goal is not to eliminate uncertainty, but to prepare for it. Risk-aware investors accept uncertainty and position themselves to survive and profit despite it. Marx also notes that risk is often misunderstood because human psychology interferes. People underestimate risk when markets rise and overestimate it when markets fall. Fear and greed distort judgment. Learning to recognize these biases is part of understanding true risk. Finally, understanding risk connects directly to the next chapter: recognizing it. You can think about risk in theory, but you must also identify where risk exists in your portfolio and the market. Awareness is the first step toward controlling it, avoiding mistakes, and making smart investment choices. Chapter 6: Recognizing Risk. Understanding risk in theory is one thing. Recognizing it in practice is another. Howard Marks emphasizes that many investors fail not because they do not know about risk, but because they ignore it when it matters most. Risk is often invisible when markets are calm. Prices rise steadily, confidence grows, and investors feel safe. This is exactly when risk is building. Overconfidence can make people ignore warning signs. Marx warns that risk is usually highest when everyone thinks it is lowest. Recognizing risk requires attention, discipline, and honesty. Investors must look beyond the surface and question assumptions. Just because an investment looks safe on paper does not mean it is risk-free. Understanding the underlying factors that could cause loss is crucial. An example: imagine a booming stock market. Many companies trade at high prices. Earnings are strong, and everyone is optimistic. A first-level thinker sees only the upward trend and buys enthusiastically. The thoughtful investor asks, is this growth sustainable? Are prices too high relative to value? What could go wrong? Marx also emphasizes that risk is relative. Different investors perceive it differently based on experience, resources, and temperament. Recognizing risk requires understanding your own limits and your capacity to handle potential losses. Not everyone can tolerate the same amount of uncertainty. Another important point is that risk is not always obvious. Sometimes it hides in complexity. Complex financial products, poorly understood businesses, or high leverage can create hidden risks. Marx encourages investors to dig deep, ask hard questions, and avoid situations they do not fully understand. Recognizing risk also involves awareness of cycles. Markets move through periods of optimism and pessimism. Peaks are often followed by sharp declines. Valleys are followed by recoveries. Understanding where we are in the cycle helps investors see potential dangers before they become reality. Finally, recognizing risk sets the stage for controlling it. Once you can identify where risk exists and how it can affect you, you can take steps to mitigate it. Discipline, diversification, patience, and careful analysis all come into play. Awareness is the first and most important step in protecting capital and making intelligent investment decisions. Chapter 7. Controlling Risk. Recognizing risk is only half the battle. Howard Marks emphasizes that the next step is controlling it. No investor can eliminate risk completely. Every investment carries uncertainty. The key is to manage risk intelligently so that losses are limited and long-term survival is possible. Controlling risk starts with discipline. Impulsive decisions, chasing trends, or following the herd increase exposure to loss. A disciplined investor sets rules and boundaries. They stick to strategies that protect capital first and seek gains second. Survival in the market is more important than short-term excitement. Diversification is another fundamental tool for controlling risk. Spreading investments across sectors, asset classes, and geographies reduces the impact of any single loss. Marx warns that concentration may lead to high rewards, but also magnifies potential disaster. The thoughtful investor balances opportunity with protection. Margin of safety is central to risk control. Buying assets below their intrinsic value provides a cushion against unforeseen events. If the market falls or the investment underperforms, the margin of safety helps prevent permanent loss. Marx stresses that this principle is more important than chasing high returns. Controlling risk also means understanding leverage. Borrowed money can amplify gains, but it also magnifies losses. Many investors fail because they do not fully appreciate the dangers of leverage. Marx advises caution and careful assessment before using borrowed funds. Patience is another critical component. Markets do not always provide immediate rewards. Trying to force outcomes increases risk. Waiting for the right opportunity and acting decisively when it appears is far safer than constant trading. Controlled patience allows the investor to avoid unnecessary danger. Marx also highlights the importance of continuous monitoring. Risk is not static. Economic changes, company developments, or market shifts can alter risk levels. Investors must stay alert, reassess their positions, and adjust strategies as needed. Finally, controlling risk is deeply linked with all other aspects of thoughtful investing. It builds on second-level thinking, understanding value, comparing price to value, and recognizing market cycles. Without control, even the best analysis can result in losses. With it, the investor positions themselves for long-term success. Mastering risk control prepares the investor for the next crucial lesson: being attentive to cycles. Markets move in patterns, and understanding these cycles can improve timing, reduce risk, and create opportunities. Chapter 8. Being attentive to cycles. Markets move in cycles. Howard Marks emphasizes that understanding these cycles is essential for thoughtful investing. Prices, sentiment, and economic conditions rarely move in straight lines. Booms are followed by busts, optimism swings to pessimism, and fear often replaces greed. Recognizing these patterns helps investors avoid mistakes and seize opportunities. Cycles exist because human behavior is repetitive. Investors respond emotionally to events. They become euphoric during good times and fearful during bad times. These swings affect prices more than fundamentals in the short term. Being attentive to cycles means seeing beyond current conditions and anticipating changes in sentiment and value. Marx explains that cycles can be broad or narrow. A broad cycle might be a decade-long bull market followed by a recession. A narrow cycle could be a single stock or sector reacting to news or earnings reports. Both levels matter to investors who want to manage risk and maximize returns. An example. During a booming economy, optimism drives stock prices up. Everyone expects growth to continue. Many investors ignore risks. Valuations become stretched. The thoughtful investor sees the cycle maturing and prepares for a potential downturn. Conversely, when the market crashes, fear dominates, prices fall, and bargains appear. Recognizing the low point of a cycle can be more profitable than riding the wave at the top. Marx emphasizes that cycles are rarely predictable in exact timing. No one can say precisely when a boom will end or a crash will begin. But understanding where we are in a cycle allows investors to adjust their behavior. They can be cautious at peaks and aggressive at troughs. Another key point is that cycles affect risk perception. Investors often underestimate risk during expansions and overestimate it during contractions. Being attentive to cycles helps avoid these common psychological errors. Risk awareness and cycle awareness work together to improve decision-making. Attentiveness to cycles also connects to contrarian opportunities. When the crowd is overly optimistic, the prudent investor may be defensive. When fear dominates, the contrarian can identify bargains. Awareness of cycles provides the context for these decisions. Finally, understanding cycles prepares the investor for the next lesson. Awareness of the pendulum. Marx uses the pendulum as a metaphor for human emotions swinging between greed and fear. Recognizing these swings helps investors anticipate changes, manage risk, and act when opportunities arise. Chapter 9. Awareness of the pendulum. Howard Marks uses the pendulum as a metaphor to explain investor behavior and market cycles. Human emotions swing like a pendulum between greed and fear, optimism and pessimism, confidence and doubt. Understanding these swings is essential to avoid mistakes and spot opportunities. The pendulum moves naturally. During a boom, optimism grows, risk is ignored, and prices rise above true value. Investors become euphoric. They assume the good times will last forever. The first-level thinker is drawn into the excitement, chasing returns and ignoring risk. The second-level thinker steps back and observes. They ask, is the market swinging too far? Is the pendulum about to reverse? Conversely, during downturns, the pendulum swings toward fear. Prices drop, pessimism dominates, and investors panic. The first-level thinker sells in despair, often at the worst time. The thoughtful investor sees potential bargains, understanding that fear may have pushed prices below intrinsic value. The pendulum does not stop at rational levels. It often overshoots in both directions. Marx emphasizes that awareness of the pendulum is closely linked to discipline. Emotional reactions are natural, but allowing them to dictate decisions is dangerous. By recognizing the swings, investors can act deliberately instead of impulsively. Timing decisions in alignment with the pendulum can reduce risk and enhance returns. Another key point is that the pendulum affects not only individuals, but entire markets. Crowds exaggerate swings because emotions are contagious. During bubbles, even skeptical investors may get caught up. During crashes, even cautious investors may feel pressured to sell. Understanding this collective behavior is essential to anticipate extremes. The pendulum also relates to cycles discussed in the previous chapter. Cycles describe patterns over time, while the pendulum explains the emotional force driving those patterns. Together, they provide insight into market dynamics and help investors position themselves effectively. Marx cautions that awareness alone is not enough. Investors must combine it with valuation, price analysis, and risk control. Observing the pendulum without acting on it, or understanding value, may lead to missed opportunities. Awareness allows thoughtful investors to be patient when others panic and cautious when others are euphoric. Finally, understanding the pendulum leads naturally into the next lesson: combating negative influences. By recognizing emotional swings, an investor can guard against outside pressures, noise, and popular opinion that often distort judgment and amplify mistakes. Chapter 10. Combating negative influences. Howard Marks emphasizes that thoughtful investing requires independence of mind. Negative influences, crowd behavior, media hype, and popular opinion can distort judgment. To succeed, investors must recognize these pressures and act deliberately rather than reactively. One major negative influence is the crowd. People tend to follow the majority, assuming the group knows best. This herd mentality drives prices to extremes. During booms, optimism spreads and risk is ignored. During downturns, fear spreads and undervalued opportunities are overlooked. Marx warns that following the crowd often leads to buying at the top and selling at the bottom. The media is another powerful influence. Headlines exaggerate events, creating urgency or panic. News often highlights short-term movements instead of long-term fundamentals. Investors who react to media narratives risk making impulsive decisions that contradict their own analysis. Marx advises filtering information carefully and focusing on what truly matters. Popular opinion can also mislead. Analysts, experts, and market commentators often echo prevailing sentiment. While some advice is useful, much of it reflects short-term trends rather than underlying value. Thoughtful investors must form independent judgments based on research, experience, and careful reasoning rather than listening blindly to others. Emotional biases are also a key negative influence. Fear, greed, overconfidence, and envy can cloud judgment. Recognizing these internal pressures is as important as resisting external ones. Marx stresses self-awareness and reflection as tools to counter emotional distortions. An example: during a market bubble, everyone praises high-flying stocks. Headlines say prices will keep rising. Ordinary investors feel pressure to buy to avoid missing out. A thoughtful investor, aware of negative influences, questions the hype. They analyze value, assess risk, and may choose to avoid the frenzy. Over time, this independent approach protects capital and positions them for better opportunities. Marx also highlights the importance of patience. Resisting negative influences often means standing apart from the crowd, which can feel uncomfortable. Yet long-term success requires discipline to avoid short-term pressures. Being contrarian when necessary is not about being stubborn. It is about aligning actions with reasoned judgment. Finally, combating negative influences naturally leads into the next lesson: contrarianism. Once you resist the pressures of the crowd and media, you are prepared to act independently, sometimes taking positions opposite to popular opinion, and benefiting when the pendulum swings back to rational levels. Chapter 11: Contrarianism. Howard Marks explains that contrarian thinking is one of the most powerful tools in investing. Being contrarian means acting differently from the crowd. It does not mean being contrary for the sake of it. It means making independent, thoughtful decisions when the majority is guided by emotion rather than fundamentals. Markets often overreact to news, creating opportunities for those willing to go against prevailing sentiment. During a boom, prices can rise far above intrinsic value as optimism spreads. Most investors join the frenzy, assuming the trend will continue. A contrarian steps back, evaluates the situation, and may choose to sell or avoid overpriced assets. Conversely, during market downturns, fear dominates. Prices drop sharply, even for fundamentally sound investments. Most investors panic and sell, locking in losses. The contrarian sees opportunity, recognizing that fear has exaggerated risk and created bargains. Acting against the crowd in these moments can lead to significant gains. Contrarianism also requires courage. Acting differently from the majority can be uncomfortable. Friends, colleagues, and media often criticize contrarian choices. Marx emphasizes that thoughtful investors must trust their analysis and judgment even when others disagree. Long-term results reward independence, not conformity. Another key point is that contrarianism is not about predicting short-term market movements. It is about understanding value, cycles, and human behavior. It requires second-level thinking, awareness of market swings, and recognition of negative influences. Only then can contrarian actions be successful and rational rather than reckless. An example: suppose a sector is extremely popular, with soaring stock prices. Most investors believe growth will continue forever. A contrarian looks deeper, comparing price to value, assessing risk, and may decide to avoid or reduce exposure. On the other hand, if the sector is hated and undervalued, the contrarian may invest confidently while others panic. Marx also highlights that contrarianism works best with patience. Opportunities often arise when others are emotional. Acting impulsively or without careful analysis is dangerous. The contrarian waits for clear evidence of mispricing, ensuring actions are grounded in reason. Finally, understanding contrarianism leads naturally into the next lesson: finding bargains. Once you can resist crowd pressure and act independently, the next step is to identify assets where price is below intrinsic value. This combination of independence and valuation is the heart of successful investing. Chapter 12: Finding bargains. Howard Marks emphasizes that finding bargains is at the core of value investing. A bargain occurs when an asset's price is below its intrinsic value. Buying at a discount reduces risk, increases potential reward, and provides a margin of safety. The thoughtful investor constantly looks for these opportunities. Finding bargains requires patience and discipline. They are rarely obvious and often appear when the market is fearful or irrational. Many investors overlook bargains because they are focused on short-term price movements, trends, or popularity. Marx stresses that opportunity often arises when others are distracted by emotion. One way to identify bargains is to focus on fundamentals. Analyze a company's earnings, assets, growth potential, and cash flow. Compare these metrics to the market price. If the price is significantly lower than the intrinsic value, a potential bargain exists. The key is independent analysis, not following the crowd. Marx also highlights the role of market sentiment. Prices often deviate from value because of fear or greed. During panic, strong companies may be sold indiscriminately, creating hidden opportunities. During euphoria, weak companies may be overvalued, creating risks. The thoughtful investor sees value where others see only fear. Another aspect is patience. Bargains are not always available. Trying to force investments when no true bargains exist can lead to overpaying or taking unnecessary risks. Waiting for the right opportunity requires discipline, but often produces superior results over time. Bargain hunting also demands second-level thinking. Many investors assume that low prices alone indicate opportunity, but a thoughtful investor asks, why is this price low? Is it temporary or permanent? Could the company deteriorate further? Understanding context and probability separates true bargains from traps. Marx reminds investors that finding bargains is closely linked to risk management. Buying below value reduces the chance of loss. It also increases the likelihood of strong returns when the market eventually recognizes the asset's true worth. Bargains are not just about price. They are about risk-adjusted opportunity. Finally, recognizing bargains prepares the investor for the next lesson: patient opportunism. Once you identify opportunities, the key is to act at the right time, combining patience, discipline, and insight. A bargain today may not be a bargain tomorrow if circumstances change, and timing decisions carefully maximizes returns. Chapter 13. Patient Opportunism. Howard Marks emphasizes that successful investing requires patience as much as insight. Patient opportunism is the ability to wait for the right opportunities and act decisively when they arise. It is not about constant trading or impulsive action, but disciplined, well-timed decisions. Markets do not always present perfect opportunities. Mispriced assets or bargains appear intermittently, often when fear or panic dominates. Impatient investors may act too early, take on unnecessary risk, or settle for suboptimal returns. Marx stresses that patience is a strategic advantage, allowing thoughtful investors to wait for conditions that maximize reward relative to risk. Patience also means resisting the pressure of short-term noise. Media headlines, analyst predictions, and peer behavior can create a sense of urgency. Acting on these pressures often leads to mistakes. The patient opportunist maintains focus on fundamentals, cycles, and valuation, ignoring distractions that do not affect the long-term value of an investment. Timing is another critical aspect. Acting too early may tie up capital in an underperforming asset. Acting too late may miss the window for gain. Marx explains that patient opportunism involves continuously monitoring opportunities, evaluating risk and value, and being ready to act decisively when the odds are favorable. An example: imagine a market downturn. Many assets are sold indiscriminately, creating potential bargains. A patient opportunist does not rush to buy everything cheaply. They analyze fundamentals, assess risk, and choose investments that offer the highest probability of favorable returns relative to risk. By waiting for clarity, they maximize the chance of success. Marx also highlights that patience is psychologically challenging. Waiting without acting feels uncomfortable. Yet long-term investing requires the discipline to remain patient while preparing for decisive action. Emotional self-control and confidence in analysis are critical traits of the patient opportunist. Another key point is that patient opportunism is not passive. It requires active observation, research, and readiness. While waiting, the investor continues to learn, refine judgment, and evaluate the changing market landscape. Preparation allows action when opportunity arises. Finally, patient opportunism naturally leads to the next lesson: knowing what you do not know. Even the most prepared and disciplined investor cannot predict everything. Recognizing limitations, being honest about uncertainty, and staying humble enhances decision-making and supports patience in taking calculated opportunities. Chapter 14. Knowing what you don't know. Howard Marks emphasizes that humility is a crucial trait for investors. Knowing what you do not know is as important as knowing what you do know. Overconfidence is a common pitfall. Believing you have all the answers can lead to reckless decisions, excessive risk, and losses. Recognizing limits allows investors to make more thoughtful and cautious choices. It encourages careful analysis, risk management, and seeking additional information when needed. Mark stresses that accepting uncertainty does not mean inaction. Instead, it means acting with awareness of what is unknown and making decisions that account for probabilities, not certainties. Marx points out that no one can predict markets perfectly. Economic events, geopolitical shifts, or unexpected company developments can change outcomes. Investors who pretend to know everything are often surprised by events outside their control. The thoughtful investor acknowledges these uncertainties and plans for a range of possible scenarios. An example: suppose an investor is considering a new technology stock. First-level thinkers may assume success because of hype or growth projections. A humble investor recognizes that many unknown factors could affect the outcome. They assess risk, seek additional insights, and only commit capital when the potential reward justifies the uncertainty. Knowing what you do not know also helps in decision-making under complexity. Investments often involve multiple variables, each with uncertainty. Understanding the limits of one's knowledge encourages caution, diversified approaches, and reliance on probabilities rather than absolute predictions. Marx also emphasizes the importance of continuous learning. Investors who recognize their gaps in knowledge actively seek to fill them through research, observation, and experience. This curiosity enhances judgment over time and reduces the likelihood of repeating mistakes. Finally, acknowledging what you do not know is linked to risk awareness, contrarian thinking, and patient opportunism. By accepting uncertainty, investors can remain disciplined, avoid herd behavior, and act decisively when opportunities arise. This understanding prepares the investor for the next lesson: having a sense of where we stand. Once you know your knowledge limits, you can better evaluate your position relative to the market, cycles, and opportunities, enhancing timing, judgment, and strategic decisions. Chapter 15. Having a sense for where we stand. Howard Marks emphasizes that understanding your position in the market cycle and the investment landscape is critical for successful decision-making. Having a sense for where we stand allows investors to assess opportunities, risks, and timing with greater clarity. Markets are not static. Prices, sentiment, and economic conditions shift constantly. Knowing whether the market is near a peak, trough, or somewhere in between affects both risk tolerance and potential reward. Investors who ignore this context are more likely to overpay during euphoria or miss opportunities during panic. Marx explains that a sense of position comes from observing multiple factors: market cycles, investor psychology, valuation levels, and economic indicators all provide insight into where the market may be headed. No single indicator is sufficient, but combining observations improves judgment. An example: during a prolonged bull market, prices rise steadily and optimism spreads. Investors may feel safe, but risks increase as valuations become stretched. Those with a clear sense of where we stand recognize that the market is likely near a high point and adjust strategies accordingly, becoming more cautious or reducing exposure. Conversely, during a downturn, fear dominates, and assets may trade below intrinsic value. Investors with awareness see potential bargains and may increase exposure, confident that the pendulum will eventually swing back toward normalcy. The ability to act differently from the crowd depends on knowing your position. Marx also emphasizes that this sense is probabilistic, not precise. Investors cannot predict exact tops or bottoms. Instead, they assess probabilities, evaluate risk-reward ratios, and position themselves accordingly. This disciplined approach reduces the likelihood of being caught off guard by market swings. Another key point is that knowing your position enhances risk management. When you understand where the market stands, you can adjust allocations, hedge exposure, or seek defensive opportunities. It allows investors to balance caution with readiness to act when favorable conditions arise. Finally, having a sense of where we stand connects to the next lesson: appreciating the role of luck. Even with skill, analysis, and awareness, unforeseen events influence outcomes. Recognizing both your position and the unpredictable role of chance helps investors remain humble, adaptable, and resilient. Chapter 16: Appreciating the Role of Luck. Howard Marks emphasizes that luck plays a significant role in investing. No matter how skilled, disciplined, or knowledgeable an investor is, chance events can influence outcomes. Recognizing the role of luck helps maintain humility, avoid overconfidence, and make better decisions. Luck can be positive or negative. A good investment may succeed partly due to favorable timing, market sentiment, or unforeseen events. Conversely, a carefully analyzed investment may fail due to unexpected circumstances. Marx stresses that distinguishing skill from luck is crucial for learning, risk management, and maintaining perspective. Understanding luck also reduces the tendency to overestimate one's abilities. Many investors attribute all successes to skill and all failures to bad decisions. This bias can lead to overconfidence, excessive risk-taking, and repeated mistakes. Appreciating luck keeps expectations realistic and judgment balanced. An example: imagine two investors analyze the same undervalued stock. One invests just before the market recognizes its value and earns a large gain. The other invests just before a temporary setback and experiences a loss. Both followed similar processes, but chance influenced the outcomes. Recognizing this prevents false conclusions about skill or knowledge. Marx also highlights that luck interacts with patience, timing, and risk management. Being prepared and disciplined allows investors to take advantage of favorable circumstances when luck presents itself. Conversely, poor preparation can magnify the effects of bad luck. Thoughtful investors focus on factors they can control while acknowledging uncertainty. Another key point is that appreciating luck enhances decision-making in a probabilistic framework. Investors consider the range of possible outcomes, not just the most likely one. This approach balances optimism and caution, improves risk management, and encourages strategies that survive even in adverse scenarios. Finally, understanding luck connects naturally to the next lesson: investing defensively. Recognizing that chance events can create losses reinforces the importance of protecting capital, avoiding overexposure, and using disciplined strategies to preserve wealth under all conditions. Chapter 17: Investing defensively. Howard Marks emphasizes that defensive investing is about protecting capital while seeking reasonable returns. It is not about avoiding risk entirely, but managing it intelligently. Defensive strategies help investors survive downturns, minimize losses, and stay in the game over the long term. A defensive investor prioritizes preservation of capital. Rather than chasing high returns with high risk, they focus on investments that offer stability, predictable income, or intrinsic value. Marx stresses that avoiding significant losses is more important than maximizing short-term gains. Survival is the foundation of wealth creation. Diversification is a key defensive tool. Spreading investments across asset classes, industries, and regions reduces the impact of any single failure. While diversification may limit the highest possible returns, it provides insurance against unforeseen events, market cycles, and volatility. Another defensive principle is margin of safety. Buying below intrinsic value provides a cushion against errors, market swings, or unexpected challenges. Marx emphasizes that this margin is not a guarantee, but it significantly reduces the likelihood of permanent loss. Defensive investors also monitor leverage carefully. Borrowed money can amplify gains, but increases the risk of catastrophic loss. Marx warns that excessive leverage often turns temporary setbacks into permanent failures. Maintaining prudent levels of leverage is essential for defense. Patience and discipline are crucial. Defensive investors do not act impulsively based on market hype, fear, or media narratives. They stick to strategies aligned with fundamentals and long-term objectives, resisting pressure from short-term fluctuations. Marx also notes that defensive investing requires awareness of cycles and valuation. By avoiding overvalued assets and preparing for downturns, investors can reduce losses and seize opportunities when conditions improve. Recognizing where we stand in the market, combined with defensive tactics, strengthens overall risk management. Finally, investing defensively connects naturally to the next lesson: avoiding pitfalls. Once investors protect capital and manage risk, the next step is identifying common traps, mistakes, and behaviors that can undermine even disciplined strategies, ensuring long-term success in investing. Chapter 18: Avoiding Pitfalls. Howard Marks emphasizes that even experienced investors can fall into common traps. Avoiding pitfalls is crucial for long-term success. Mistakes often arise from emotional reactions, overconfidence, lack of discipline, or ignoring fundamentals. Recognizing these dangers allows investors to act more thoughtfully. One common pitfall is following the crowd. Herd behavior can push prices far above value during booms or below value during downturns. Many investors buy at peaks and sell at lows because they let sentiment, hype, or fear dictate decisions. Marx stresses independent analysis and contrarian thinking as defenses against this trap. Overconfidence is another danger. Investors who assume they know everything or can predict the market perfectly often take excessive risk. This can lead to large losses when unforeseen events occur. Marx highlights humility, recognizing what you do not know, and acknowledging the role of luck as key safeguards. Ignoring cycles and market context is also risky. Investors who fail to appreciate where the market stands relative to economic and sentiment cycles may misjudge risk or opportunity. Being attentive to cycles, market swings, and valuation extremes helps avoid timing errors and poor allocation. Leverage and excessive concentration are frequent pitfalls. Borrowing to amplify returns or investing heavily in a single asset magnifies both gains and losses. Marx cautions that these strategies can create irreversible damage, especially during downturns or unexpected events. Emotional investing is another trap. Fear, greed, and impatience can cloud judgment. Panic selling during declines or euphoric buying during bubbles often results in losses. Marx advises disciplined strategies, patience, and a focus on fundamentals to counter emotional pressures. Another mistake is neglecting risk management. Ignoring downside scenarios, overestimating skill, or assuming the market will always be favorable can lead to catastrophic outcomes. Thoughtful investors control risk through diversification, margin of safety, and defensive positioning. Finally, Marx reminds us that avoiding pitfalls is not about perfection. Mistakes will happen, but learning from them, maintaining discipline, and applying second-level thinking reduces their frequency and impact. This principle naturally leads into the next lesson: adding value. Once investors avoid common traps, they can focus on identifying and capitalizing on opportunities that enhance returns and create wealth over time. Chapter 19: Adding Value. Howard Marks concludes by emphasizing that the ultimate goal of investing is to add value. Adding value means making decisions that improve outcomes, generate returns above the market average, and create long-term wealth. It requires knowledge, discipline, judgment, and the ability to act independently. Value is created through careful analysis. Understanding intrinsic worth, market behavior, cycles, and risk allows investors to identify opportunities others may overlook. Marx stresses that second-level thinking, contrarian approaches, and awareness of cycles help uncover situations where value can be added. Patience and timing are essential. Adding value is not about constant trading or reacting to every market movement. It is about waiting for opportunities where the reward exceeds the risk and acting decisively when those opportunities appear. Patient opportunism ensures that actions are both strategic and effective. Risk management is a critical part of adding value. By controlling risk, maintaining diversification, and applying a margin of safety, investors protect capital while positioning themselves for favorable outcomes. Marx emphasizes that preserving capital is as important as seeking profits because losses can destroy the ability to add value in the future. Contrarian thinking enhances value creation. Acting differently from the crowd allows investors to buy undervalued assets when others are fearful and sell or avoid overvalued assets when others are euphoric. Recognizing negative influences and maintaining independence ensures decisions are rational and grounded in fundamentals. Adding value also involves continuous learning and self-awareness. Recognizing limits, appreciating the role of luck, and evaluating outcomes honestly strengthens judgment over time. Marx stresses that thoughtful investors adapt and improve by learning from successes and mistakes alike. Finally, Marx reminds us that value is long-term. Short-term fluctuations, media noise, and market hype should not distract from the goal. Adding value means making informed, disciplined decisions that compound wealth over time, while managing risk and maintaining patience. By combining second-level thinking, awareness of cycles, risk control, contrarian insight, and disciplined execution, investors position themselves to consistently add value. This holistic approach is the essence of thoughtful investing and the key lesson of the book. Thank you for listening to this audiobook summary of The Most Important Thing by Howard Marks. If you found these insights useful and want more thoughtful investing lessons, strategies, and book summaries delivered to you, make sure to subscribe to our channel. Hit the subscribe button and turn on notifications so you never miss an update. Your support helps us create more valuable content for curious minds like yours. Remember, investing thoughtfully is a journey, and every decision matters. Stay patient, disciplined, and keep learning. Subscribe now and continue your journey towards smarter investing.